And a very good evening to everyone out there. It's Wednesday evening, 27th day of July, 6:41 Eastern Time. Pardon the voice, a little raspy this evening, but we'll get through this and it'll only take a couple of minutes. A rough day for Wall Street today, with the Dow Industrials down 198, 1.5% to 12,302. At least rough for the Wall Street Bulls. The S&P 500 was down by a little more than 2%, and so we're back now with the S&P 500 at the 1304 level. Let me just scroll it up on the screen a little bit better so you can see it. 1304.89, down 27 or 2%. So really we're back where we were about a month ago. The more things change, the more they stay the same, so to speak. Gold had a kind of a roller coaster ride of a day today. It's down $1.20 now at 1,615. So there was no big sell-off in the price of gold, but gold certainly traded off the best levels of the day for the stock market. Nonetheless, gold remains a very compelling long-term story. Take a look at the 200-day moving average. It continues to slope higher. The 50-day average, yes, it did stall out for a little while during late June, early July, but it's on the way back up again as gold is now finding itself getting more and more comfy in this 1,600 plus range, although you still can't write off the possibility that 1,600 will be retested, but more than likely we are going to continue to forge onwards and upwards. Relative strength, not extreme, but it is high here for the price of gold. So yes, it could be subjected to some fairly short and maybe sharp little corrections depending upon what happens in the market. So why did the Dow Jones Industrial Average pull back by 198 points? Are they getting a little more sensible down there on Broad and Wall and realizing what's going on? And certainly the ongoing debt melodrama in Washington continues to keep investors nervous. And we're also seeing a continued string of weak economic data, the durable goods, and the beige book not portraying any kind of great economic strength, but really showing us economic weakness. And so there was a triple whammy of events here for the market to react to, and yes, we did see the pullback in the stock market today. Going back to my stock charts here from stockcharts.com, there is one area that I should note here that has been nice and fairly strong so far, and you would do well to pay heed to these utilities here. The XLU has actually, if you look at the bottom portion of this chart here, it's actually been outperforming a little bit, at least in the last couple of days, the S&P 500, even though on a actual day-to-day basis, what we are seeing a little string here of lower highs, and well, the lows haven't gotten to be a lower low kind of a situation, but there is more hesitation in these utilities. But the utility group as a whole has held up fairly well in comparison to the overall S&P 500. That's something to consider. The smoke alarms have been going off with respect to the Washington, D.C. Debt shenanigans in the debt default swap market. And those folks there are pretty serious players, although by and large the retail customer is pulled out of Wall Street. That particular playground is still subject to manipulation, and there certainly just seems to be an ongoing air of don't worry, be happy in the stock market, with perhaps the exception of a day like today. But in the CDO market, something happened for the first time ever, and that is that debt default swaps inverted, meaning that it costs now more to insure a 1-year treasury than it does a 5-year. So this denotes that there is concern in the short term, perhaps not about a default, although somebody here quoted in this Bloomberg story says it expresses concern about default. I think it really shows concern about the likelihood that we are going to see a downgrade in the U.S. Credit rating by either Moody's or Standard & Poor's or Fitch or all three of them. And that actually would end up being a very counterproductive situation, what with the small proposals that have come out to reduce spending. The tax hikes have been pretty much off the table, and a default, or actually not a default, but a downgrade of debt would result in higher borrowing costs, and it would probably negate whatever sized amount of cuts are proposed over the next 10 years if you're going to add 100 billion plus, depending upon how deeply they downgrade the U.S. If you're going to add 100 billion plus in additional borrowing costs over 10 years, well, that wipes out a lot of any other cuts that are being proposed. So those are like the canaries in the coal mine, so to speak. Yes, the Dow finally gets around to pulling back a little bit. Maybe folks are scratching their heads and saying, this might actually be a serious situation, even a credit downgrade. And there's the periphery out there that talks about liquidity freezes should the credit rating come down just based on the trading of various and sundry derivatives. So we'll just have to see how the day pops up for Wall Street tomorrow. At this juncture, the S&P futures are up by 2.25 points. You really can't tell a lot from these futures trading during the evening and the overnight, but they're trying to come back to life as of this evening. Have a great evening, folks, and we'll be back with more market commentary come tomorrow morning. Thanks for listening.